um, and I would imagine that all of you are FERM students, correct? Is there anybody who is not in the FERM program? Okay, so I would imagine that yes, you are all FERM students. So let me greet you and welcome you to 5323. And I would imagine I actually did not teach I teach two classes in the FERM program. One is in fall, the other one is in summer. I teach nearly half of each of the classes. This class will have 12 sessions, as you know. Normally we have about 13 to 14, but for special reasons which I'm not fully aware of, we will have 12, of which I will be taking 7 classes, and Professor Vladimir will be teaching 5. My 7 classes, I've already sent out the syllabus. By the way, we have about 11 students now, so I am missing at least 8. 3 of which have already informed me that they will not be able to attend the class. So the same rule applies, that if you cannot attend the class because of personal or professional reasons, you will please simply inform me ahead of time. Today being the first class, let me also ask you that have you been able to, I know that you have been getting my email messages because I can see that all of you are here in time. And some, as I said, have not been able to make the class. By the way, can you hear me clearly? Okay, good. So, and as I tell you that it is not required that you be on video, but it is something that will help in the sense that it helps participation. It helps sort of, it gives you sort of feeling of, yes, everybody is connected. So if you will please be on video, unless there are other technical restrictions or difficulties because of which you cannot, I understand. Otherwise, I think that being on video does promote participation. There is no question about it. So I presume that you have received the emails and also that you have been able to actually take a look at the material that I have posted. Is that correct? Have you been able to see? Okay, I can see some of you shaking your heads. So this is, given the amount of time we have, this is a pretty intense class, simply because, first of all, I expect that none of the material here is new to you, because I think that all of you must have had some exposure to options, which will be maybe the first 2 and maybe one more class. Now, I expect that some of you took 5408 with me last fall. Is that correct? Is there anybody who took the valuation class 5408 with me? Okay, so I can see that Julia did. So there will be not repetition, but there will be some, a little bit at least. Definitely the first 2 classes are on options. So I expect that, yes, there will be some repetition, but we will definitely be going beyond what we did in 5408, but there is going to be some repetition. But after looking at the exam and after looking at or interacting with some of the students that were in the SMF, that means the Student Managed Fund, is there anybody here who was in the Student Managed Fund? Anyone? Okay, possibly not. So I can tell from the student fund managers, some of whom are actually all of whom were in by 5408, that not everybody followed what we did in options. So I believe that the material that we will be discussing today, you possibly have already, I'm sure you have had in several classes. So I'll go through this material very quickly. But I think also that now, I don't know if you had, I'll go through the syllabus in a minute, but so some of the material in the first 2 classes, particularly today, may be a little repetitive. Tomorrow's class is not. So I know that you have not had any material or any analysis and valuation of convertible bonds, which is what we will be doing next class. So at this point, it will be good to take a look at the syllabus. So if I am still good at do you see the syllabus?
Yes, we do.
Can somebody speak up? I cannot hear anybody.
Yes.
Good.
Yes, we can see it.
Good. Thank you very much. I mean, I presume that you have already seen it before, but as you know, all of the classes will be on WebEx, and here is the Harvard course pack. Now, all of the material for this class, not all, I will be bringing in my own stuff also, some of which you will see today, both PowerPoint as well as Word. You will definitely be able to actually, those have already been posted. What has not been posted, and I will not be able to post for copyright reasons, I can project them, but I cannot post them. So it is absolutely essential that you get your own copies of the Harvard cases. I don't remember how many cases I have assigned. To get to all of this, that is the expectation. Now, obviously, as you know from the Harvard cases, that not everything can be discussed in class. So I will definitely be going through as much as possible, but you will be responsible for the rest of the materials. It is expected, which I definitely do not expect today, as well as tomorrow, because of the I mean, you may not have had the cases and all that, although I posted this about at least a week ago. But if you do not have the cases, I will expect that you may not have the material or you may not have time to study it for the first two classes. So I will definitely go a little slower on the first two classes. However, the expectation is that you will at least browse and familiarize yourself with the cases that are assigned for the next two classes. And so it is definitely expected that you will be doing that. And then I don't know if anybody has looked at the course pack, but I believe it is about $49.50, which is at a 50% discount to the students. That means that if you were to buy the same course pack yourself, it will cost you close to $80. So it is discounted for students that are in this class. So let's look at the dates. There was some confusion about the dates, at least actually on my part, but I know these dates are firm now. The one date that was added at the last is the July 7th, and it says in-class group exam. I am not absolutely sure about that. It all depends on the progress we make. And let me just point out to you. So these are the sessions, all of which will be on WebEx online. And I have received a couple of 3 or 4 students that have asked whether the sessions will be recorded and posted. The answer is yes. However, as I said, participation in a graduate's class definitely is not required, but strongly encouraged. There is no doubt about that I will very much appreciate you coming to class. So these dates are all firm at this point of time. The only thing is the July 7th date, which at this point is the in-class group exam. So one of the things that I did tell the program that I personally do not like is the long gap between my last class and the exam. So, but there is nothing I can do about it. I understand why they had to do it, because one of the instructors at the last moment said he cannot actually teach, which was a last moment adjustment. So this is a class that was assigned to him, which I am in two minds as to whether I will give them. What I may actually do is, rather than giving the exam on that date, I may none of this is firm. It will all depend on how the class goes, how we cover the material, how much participation there is, and how students feel that they follow the material. So And as you know from your experience with classes that you may have taken, that this class and the exam is not taught as you should not expect end of chapter type of questions at all. The questions will also be case oriented. And so if you are familiar with all of the cases that are being discussed, then you will definitely be able to handle the exam. And remember, this is a group exam. So if there are basically five, let's say, I'm thinking of a group of four, that means that 19, there are 19 students. So I'm thinking about five groups with maybe all four of them will have four and one of them will have three. I will not make the group assignment tomorrow. I will allow you to express your preferences. If you want to form your own groups of four or three, you can do so by tomorrow night. I will announce the groups next Tuesday. So I'll give you a week to form your own groups if you want, but you must send the names to me. Now you realize that if there are 5 or 6 questions in the test, then if a group of 3 or 4, you are basically responsible for maybe 1.5 questions. 3 hours for 1.5 questions is ample time. So if I use the July 7 as, let's say, a review session, just to make sure that the students are comfortable with the concepts and have not really forgotten, just to refresh your memory, I can do so. But then the exam will possibly be, I'll request Lindsay to schedule the exam that week itself. Obviously, attendance at the exam is mandatory. That means that you cannot just not attend the exam just because it is group exam. That choice, that option is not available. So how you break up the assignment is entirely up to you, whether you take 2 questions or 3 questions, I don't really care. Before, at least a week before the exam, I will tell you what the structure of the exam will be. However, you can definitely assume that each session will account for 1 question. So there will be 5 minimum, 6 maximum questions in the test. So nobody will have responsibility for more than 2. Now, obviously, I understand that if you are going to do only 2 problems in 1.5 hours, 3 hours rather, that's definitely ample time. However, you may want to actually check everybody else's answer or help everybody else out in the group. So there will be time given for that. And if the students really want a little more time, if some of them say that we would like to start at 5:30, I don't really care. We can start at 5:30, but hard stop at 9 o'clock. Now, I will talk more about the exam as we go through the semester. However, as you can understand, that this is a group exam, and of course, with full online access. So you will have access to the world. I don't really care about that. However, collaboration between students and between groups is strictly prohibited. That means that if this is just by the code of honor. However, there are ways to tell whether there has been correlation, coordination and collusion, and whether email or other Excel programs have been exchanged. You should not do that. I will remind you again before the exam that definitely is tantamount to cheating, which I expect you will abide by the code of honor and will not do that. That if there is an invitation, you will reject it. And if there is a request, you will reject it also. This is entirely up, because the point here is this, that this is a risk management class. We all take risks in life. We all face risks in risks in life. Helping others when you are not supposed to do that is whether you will take that risk or not, or whether you will entertain others taking that risk and opportunity from you. That's the trust I have on you. Otherwise, I cannot actually conduct. I monitor it. I am definitely I'm not going to say I'm not interested in. I am definitely. I will be there throughout the exam, doctored throughout the exam. Questions directly to me will definitely be answered. However, please do not use your cell phone during the exam and do not at all correspond any classmates outside your group. That's the rule that must not be violated. So violation of that rule definitely is punishable with extreme loss. So this is risk management. The rest is up to you. Okay. Feel free to stop me at any point of time, and I will be happy to answer any questions. So let's go to the material. And the material you will see is actually arranged in some form that I hope that it represents what we are discussing in this class. Valuation of options and convertibles. That's session 1 and 2. Session 1 is valuation of options. Now, and convertibles is convertible bond. Those of you that are not familiar with it, you will see that it is one of the most fascinating instruments in the market. It's not really widely talked about, but there are people who actually trade convertible bonds, and you will see why it is one of the most fascinating. Now, I say valuation of options. However, I will show you with the, let me open the next Word document, and I will try to switch between the two if I can. There is actually a Word document which says option topics. Is that on the screen right now? Have I been able to switch?
Yes.
Yes, it is.
Okay, good. That means that the switching is working. So, so definition and so this is basically the roadmap. Obviously, I will be, taking detours and all that. I will never be able to exactly stick roadmap, but this is the intended roadmap. Definition and terminology, which I'm sure all of you are familiar with. Basic values, time values, basic properties of options has to. That's mainly definition. Option attributes, you all know this: S, X, T, RF, risk-free rate, and volatility of annual stock returns. This should not have been here. I don't know how that happened. This is actually an option strategy that should not have been there. Then leveraging with options. Basically, what it really means is, I don't know why that it is doing that. Sorry. So let me see if I can do. Oops, no, it still will not take it. Okay, so what leveraging with options means, when you look at, I mean, this is now I should tell you that some of this material, not all, some of this material I have used last fall, meaning 4 months ago. And I saw no reason to change the numbers because those numbers are quite recent. That means that you will see those of you that may have taken the 5408 with me, may have some of this with you, but I looked at them and I saw that they are very, very recent. So there is no reason to change them. I did not, because changing them would mean that who knows if I make a mistake. So I basically looked over them. They look fine, they look recent, and so I did not change them. And you will see that I used an example for leveraging with options. Those of you that do not know what this means will be able to follow it. Then option strategies, by far the most important topic today. Long short call, naked call, covered call, protective put, short put, collar, straddle, and then hedging with options, short call and long put. Then obviously put call parity. Option valuation comes towards the end. And in that option valuation, you may have already had what is called the two-state option pricing model or binomial option pricing model that you may have had with Jaideep Shenoy or some other professor. I will extend it to possibly 3 time periods, and I will go through that. We will definitely extensively use the Black-Scholes option pricing model. However, will not derive that. Then applications and strategies, basically the same idea as a strategy itself, Black-Scholes model and option Greeks. All of these are basically material that I expect to cover today. But as I said, my very first class, work. So I will possibly not go beyond maybe 8:15 or 8:30, just so you have time to absorb, those of you that are not very familiar with it or have become a little rusty with this material may have time to actually review it later tonight or tomorrow and come better prepared next class, which will be tomorrow. Now, I should point out once more that the original course outline that I distributed actually had dates, those that were changed. So they are originally 12 and 14, 19 and 21. That has been changed later on. These are the confirmed dates. These are the dates that are also on PeopleSoft. So please make a note that the earlier, very early email that I sent out maybe a week ago had wrong dates. Wrong dates meaning that I did not know that those dates have been changed. But these are the firm dates now that are also in the registration system, PeopleSoft of the university. So now, with respect to the cases, all of the material is in the cases. So if you read the cases, you will be very, very prepared for the exam. Now, I will go through some of the selected parts of the cases, and that now I am sorry that this happened. This is a pop-up which shows up every once in a while. I do not know why. This is the MSFT, basically MSN network website that may pop up, but it should disappear instantly. But it will happen. It may happen a couple of times. Then the note on option valuation. This is a purely purely theoretical. I should not say theoretical. It is basically the mathematical derivation of the two-state or the binomial option pricing model. Now, I suspect this may have already been covered by Jaideep Shenoy. My approach is slightly different from Jaideep's, but we will get the same answer. Now, am I correct that he has already covered this in class? I think I remember Peter. Peter, can you hear me?
Yeah, I think that class was taught by Misha Rakamotovo. We are talking about risk management in equity markets, correct?
Good. So you remember the material?
Um, More or less. So yeah, we
Okay,
had
that's
option.
fine.
We had option evaluations. Yeah, we had the Black-Scholes model. Yes.
Yeah. So I mean, this model can be derived in different ways. I can see that the binomial has been misspelled. So let me correct that. Yeah. Okay. Then the convertible is Mogen Inc., which will be the bulk of the work tomorrow. Then there is a case that I actually included this year, which was not in the outline. So I do make changes every year. There are 3 or 4 cases that I have changed here. One of which is the bond prices and interest rate risk. This is something that I noticed that students still have difficulty. There is a lot of material that I did in 5408 on this thing. I know that I don't remember if I taught the fall class for this group. I don't recall. Possibly I did. This is definitely yes, I do recall that. This is definitely material that you should be familiar with. As to how bond prices react, I have covered this extensively in my 6 or 7 sessions in 5310. So this is very repetitive material. However, students still have difficulty understanding it. This particular case will explain away any doubts and hesitations you may have about the relationship between bond prices or fixed income and interest rates. Now, why is it that I included that? Is because of this case, fixed income arbitrage, meaning that how you arbitrage. Does everybody know what arbitrage really means? Are you familiar with this word, arbitrage? What is the definition of arbitrage? Nobody? Have you
Arbitrage is like where prices are at two different levels at two different places, or car or however you are indexes, and so you can make a free profit for a short time till the prices come back together.
I think you are right. I think maybe the words could be a little more formal, but the idea is exactly right. But the real issue here is that two assets that have same cash flow over the same period of time and same risk must sell at the same price. So the no arbitrage condition is that two assets that have exactly similar cash flows at the same points in time and have the exact same level of risk must sell at the same price. If not, if there is a discrepancy between the two prices, then you can actually design a strategy to exploit that arbitrage profit. If the two prices, let's say stock A or asset A and asset B, have the same cash flows over the same period of time and the same risk, but price of A is greater than price of B, then what strategy would you actually follow to exploit that price discrepancy? Price of A is higher than price of B, although they should be the same. What arbitrage strategy will you follow to exploit that price differential?
You're going to buy B and sell A.
Buy B and sell A. That's right. Buy the undervalued asset, sell the overvalued asset. Short sell. Why? Because by that buying and selling, price of A will drop and you have sold it, so you will make money, and price of B will increase, which you bought, and you will make money. Now, this particular case is based on a real thing that happened years ago. But the example is what is most important. And this involves two treasury assets, treasury bonds, that should sell at the same yield to maturity. Notice that I did not say price. Same yield to maturity. Now, why that is what I will explain when I come to this particular case next week. And many people, students, will always get confused between yields and prices in bonds. Now, they are very closely related to each other, but they're not the same. And notice that in this particular arbitrage, I did not say that they must have the same price, but I said they must have the same yield. And we will see when we come to this case, which is real life numbers. It uses real life numbers, which is why I like this case. And meaning that this is not a pure textbook example. This is an example made with real data. So, and we will see how we can exploit, or it was exploited, to generate hundreds of thousands of dollars. Next is Marjar arbitrage. This is a little more complicated, and this is a note on risk arbitrage is basically a sort of a mathematical analysis of how to exploit the arbitrage created when there is a merger between two stocks or two companies, A and B. And you will see that now, as I said, that the arbitrage with the fixed income or treasury bonds is not new. It actually happened. You will see the data some years ago, and does not happen now. Definitely not as often. It may be happening, I do not know, but it is exploited at tremendous speed so that it will not last very long. However, arbitrage in mergers is happening all the time. All the time. And there are people, hedge funds mainly, who actually do just this, nothing else. Absolutely nothing else. So, does anybody know what merger arbitrage really means? Have you heard that in any class?
Now you're talking about where one company is buying other, and a lot of times the company that is doing the buying stock drops, and the company that's being bought, their stock increases.
Oh, that happens all the time, Cliff.
Yeah.
That is true. I am definitely talking about a situation like this where one company is buying another company with stock. But your point that the acquirer stock price drops and the target stock price increases is always true. I'm not talking about that. I am talking about a situation where if you know that there is a stock for stock exchange, then if company A is buying company B, then company A will tell company B that for each of your stock, we will give you 2 of our stock. That means the ratio is 2 to 1. And that creates an arbitrage opportunity. That means that as soon as this announcement is made, arbitrageurs will immediately jump in that transaction. This is also a huge market. And this is one particular instance, and so is the fixed income arbitrage, where people are actually not avoiding risk at all. They are actually trying to exploit the risk. They are trying to actually take the risk. Of course, they are with all kinds of checks and balances and all kinds of hedging if necessary, so that they can actually exploit the opportunity that has been created and make money. So this is one example where market is actually exploiting the risk and managing the risk and taking opportunity of the risk. Remember, the point here is that the opportunity to make money in this particular instance has been created because of the risk. So this is not faint of the heart. This is not for me. This is a multi hundreds of millions of dollars market at any given point of time as soon as a merger is announced. But can you yourself create a strategy like that? Of course, sure. It is very easy. The mathematics is very easy. The trading strategy is very easy. But you won't be making the runaway profits that hedge managers are making, because maybe you will invest $10,000, whereas the hedge fund manager will be investing $200 million. So,
Professor, I have one question.
Yes.
So, to take advantage of this merger arbitrage, we should have the information about this company is planning to acquire or merge to another company in advance to be able to use these strategies. Is this correct?
I think that is an excellent question. Let me repeat your question. So I just want to make sure that I understand your question. So what you are saying is that this is a strategy where you know that company A is going to merge or take over company B. Is that what you are asking? That's
Yes,
exactly
yes.
the point. That is exactly the point. In fact, if you take any position in a merger arbitrage before the merger has been announced, you are guaranteed to end up in jail. Because that will tell SEC. Now, of course, if you just buy 100 shares of each or buy and sell 100 shares of each, then SEC will not come after you. But if you buy, let's say, make the money, that you buy 10,000 shares of one stock and sell 10,000 shares of the other, or in the exchange ratio, as a matter of fact, before the merger is announced, then SEC definitely will check. So, so this is not where you are exploiting asymmetric information. There is no asymmetry of information here at all. Everybody knows and everybody can participate. But you will see when we discuss this thing 2-3 classes later as to why not everybody will be interested. Because as you know, that to exploit or to take opportunity of a risky situation where your rate of return can be very, very high, you also have to be prepared that the risk can force that transaction to go in a different way. Very good question. The answer is yes. You are
Thank you.
doing this with full information. This
Yes.
is not information that you have as an advantage over others. No. Okay, the Abbott Labs and ELSA is not possibly included. I don't remember in the course pack. If it is not, I will share my copy with you. This is a case that has been in the Harvard library for a long period of time. One of the most famous cases on merger arbitrage and one of the cases that are easy to follow. They are now adding other cases, but I saw no reason to change it. The assignment that will be given to you will not be something that I will make up. I work with Professor Rakatomavo, and I have already asked him to give me examples of merger arbitrage in the market right now. So you'll be given one of those. Okay, finally, interest rate swaps. Now, I don't know. I know interest rate swaps have not been discussed by Jaideep, and definitely not by Hang Bai. Has Fan Yang discussed interest rate swaps possibly in the very first semester?
No,
We did it in the
It's
fixed
Jacob
income
that
course
discussed
last
that one.
semester.
Okay, so it was done in the fixed income class, and who taught that? Yakov?
Yeah.
Yes, Jacob. Yes.
Okay, so he did cover interest rate swaps.
Yes.
Okay, fine. But this is definitely one of the more complicated instruments. So, and I have included one case, which is basically a description of how interest rate swaps work with example. And then there is an actual case from Dominion Gas Holdings. So now in the exam, I have not decided yet. I may give you one Harvard case, which obviously is not in the course pack right now, but each group may have to buy. I have not decided on that. And if I can buy after talking to Harvard and give it to you guys, that's possible too. So this is the course outline. And one of the things that I have said here, I'm sorry, the last one is the portfolio construction. And this is, of course, if you have not really done any assignment as to how to create portfolios, this will be very fascinating. And this is where I may actually invite Professor Rakatomavo to come in. This will not take more than one class. And this particular case actually uses the Student Managed Fund at University of Virginia. So this has two parts to it, one of which, as you know, portfolio construction has two parts. If you want to actually create a portfolio, let's say that in the Student Managed Fund, what happens is that they were given, I don't remember how much, I think maybe $3 million at the beginning of the semester, and they were asked to create a portfolio. Portfolio construction and creation has two steps. Can somebody tell me what are the two steps? Because you are going to be, when you graduate in risk management area. So one of the things that you might be interested in is to become a portfolio manager, let's say 15, 20 years later, in your 40s or late 40s. Yes, you'll be a portfolio manager with, let's say, UBS. So the question is that, what are the two steps? If they ask you this simple fundamental question, that do you know what is a portfolio? Of course, you all know that a portfolio is nothing but a combination of stocks. So if they ask you, all right, tell us, what are the two most important steps in portfolio construction? What are those?
Probably you have to determine the benchmark and with that the risk. you are going
Of
to
course,
follow?
Peter. The thing is that benchmark is basically what, let's say that, for example, I will tell you that for most student funds across the country, the benchmark is the S&P 500 index, which I'm sure all of you know what that is. So yes, a benchmark. But I am talking about the benchmark is mainly for your performance evaluation. But before you get to the performance evaluation stage, you have to create the portfolio. So
Yes.
what does it take to create a portfolio? So what
So
are
you
the
have
two
to
steps?
Oh,
Your
select.
target returns.
Okay, go ahead, Edward. Please. I
Yeah.
thought you spoke. Go ahead.
Yes. Yeah. Your target returns
Target returns.
in
Okay.
plan. Yes.
See,
Yes.
all of these are performance oriented. Not wrong. I am not
Okay.
talking about that. I am asking that, let's say that your portfolio manager has two analysts and you are one of them. So he told you that, I actually will give you 7 days and I want a portfolio of 5 stocks, diversified, or 10 stocks. Come back in a week and tell me the portfolio. What is it that he is looking for? What information do you have to submit to him? What report?
So probably like on which kind of index you select those stocks and like what kind of a percentage of each of those stock the allocation and maybe what's your
Okay, so
diversification
there are
strategy.
2 steps.
I think we should determine our risk appetite and objective from the portfolio.
Okay, okay. Once
Um,
again,
I
uh,
think
yeah, go ahead,
we are
please.
looking at asset selection, choosing the investments, then asset allocation,
That's
deciding how
exactly
much
the
to
word I was.
invest.
Selection is step 1, allocation is step 2. That's the correct. All of the answers that you have given me are correct. I was looking for those 2 words, selection and allocation. Now, let me ask you, which of these 2 do you think will actually have more influence on your rate of return, the selection or allocation? Now, you might say both, and that will be correct. I'm saying, relatively speaking, which decision is going to be more critical?
I think it's selection.
Okay. Okay. Now, let me ask you. I think it came for Christine. That's okay, Christine. Let me ask you that you selected 10 stocks, and somebody else in the class also selected the same 10 stocks. So your selections are the same. Will your rate of return be the same?
No, it's gonna depend on the allocation of the stock.
That's exactly the point. That is exactly the point. That if you had, let's say, for example, NVIDIA today, NVIDIA, I think, went up a little bit or went down. I don't remember. That doesn't really matter. It is not only important that you had NVIDIA or American Express or IBM or anything in your portfolio and the stock went up. That information is very important. You will know that, yes, my portfolio made some gains. However, how much gain your portfolio made depends on how many shares of that particular stock you have. So, for example, if when I started my career, which is many years ago, if I had invested all my money on just Microsoft at that time, when I think the stock price was maybe $15 or $20 or whatever, I would have long retired. So the question is not now, of course, I did not do that simply because I don't have that much nerve because as you know, I don't know how many of you, let me see, how many of you know how Microsoft has performed over the last year.
Microsoft's done
Microsoft,
pretty good.
okay. Take a look when you go back home. I think during the year, last year, or maybe a year and a half, Microsoft at one point of time was something like 520 or so. It is at 410 today. So if you owned Microsoft stock, you have lost 20% over the last year or so. That it's actually one of the worst performing stocks. But I know many fund managers have asked, did you unload? Should I do that? They said no, just stick with it. Well, we will hope that it will come back, but that is one of the poorest performing stocks at this point of time. So one of the best performing stocks, of course, have been Nvidia and Google. Those stocks, if I held only those, then I would be a lot richer today. But the point I'm trying to make is allocation is very, very important. And in fact, the portfolio theory for which Harry Markowitz won the Nobel Prize, which is basically risk management, as you know, that he won the Nobel Prize because he is the creator of mutual funds. And no matter what anybody tells you, if you really want to make sure that many of you are in your late 20s or so, maybe early 30s, if you want to make sure that I have enough and I will be retiring, let's say at 55 or 65 or whatever, 25 years or 30 years, and I want to make sure that I have enough money to retire without taking substantial amount of risk, then just buy the Vanguard S&P 500 index and let the US capital market take care of your money. That's not me saying. That's what the greatest investor of all time, although he doesn't do that, Warren Buffett is saying. That just put your money in the US capital market by buying what is called SPY. SPY is the ETF on S&P 500 index, the least costly investment that you can make. And the average, I should not say average, the compound annualized growth rate on S&P 500 index is around 9%. You don't really need to do anything more. Okay, so what I was trying to show you that risk management is not just about measurement of risk, because I know that in your classes you have gone through significant amount of measurement of risk by VAR and all of that. The real focus on this class is actually how to manage risk to your advantage. That the idea here is not that you avoid the risk. Idea is that how you can actually take opportunity of a situation that has been presented to you by the market because of the possible mispricing or relative mispricing of assets. So that's the main focus here. Now, I will actually start by looking at Microsoft options chain. And for that, I already opened, hold on for a second. This is the options chain. I hope you can see it. Very easy to get to. This is yahoo.com. Now I subscribe to Yahoo, but if you go here, can everybody actually see the options chain?
Yes.
Yes.
So I am going to, if you go here, you will see a series of dates. I will get to my slides a little later, but I thought I should give you a first look at the options market as to how they are traded and how they are quoted. So these are the dates on which options expire. Unlike stocks, options do not exist after a certain point of time. For example, there is an expiry on May 15, and I am going to look at, let's say, a 6-month option, which will take me to, let me see, there is a November right here. I thought I saw in November right here. So this is about, you can say, 6 months. And I am going to keep to all strike prices list, and I'm not going to go to all options, or maybe that's fine. So all I have changed is basically the expiry date. What this means is that the options that are listed here right now are not going to actually exist after November 20, 2026. So you don't have to do anything. If you buy that call option will not exist. So here are the strike prices. And of course, all of you are very familiar with the definition of call option. So let's go to, notice that in this listing, there is a strike price of 200 to strike price of 700. Okay, so there is a huge range of strike prices. But let's and notice that there is some options are listed in light blue, some options are listed in a white background. And the difference between the two happens at almost exactly the current price, stock price of Microsoft. Current stock price of Microsoft is 407. Now, some of you may doubt the statement that I made, and to prove that, I'm going to go to, let's say, Google and look at the Microsoft stock. And you will see the volatility of Microsoft. So let's go to MSFT. Can you see the screen?
Yes, sir.
Yes, we can.
So I'm going to go to Microsoft stock. And notice that it lost another $5 today. And there is not much change in the aftermarket. But let's go to 1 year. This stock was at 541 on October 29, 2025. And today it is 407. That means for 540, it has dropped roughly $130, which is what? 54 over 13 is roughly what? About 26, 25%. That's huge drop. Huge drop. And the unfortunate part of it is that anybody that invests in the market possibly owns Microsoft. But another way of looking at it is, okay, let's see how it has done over 5 years. That's when it looks a little different. But notice that it seems to be coming back here. That means that there was a similar drop in April 2025, more than a year ago. And after that, this was about 259. This is 359, 356. So there seems to be some kind of a barrier there. But notice also that way back in 2023, about 3 years ago, it was 224. So it still hasn't given you a 100% return in 6 years. Many stocks have. So Microsoft has not been a good performer definitely very poor in the last year or so. And right now, now everybody that I talk to says, no, we are not going to sell it, simply because you have so much confidence in this thing. Why? Because if you look at maths, you will see why there is. But notice the sharp drop here. So if you bought, let's say, Microsoft in 2018, immediately, or let's say after COVID, 2020, it was 183. It's 407 today. Maybe you are not too upset. But on the other hand, if you if you have owned it through, then you have some reason to be very disappointed with the stock at this point of time. There's no question about it. That there has been tremendous volatility and tremendously disappointing performance for Microsoft. Now, day to day, if you have owned it for the last month or so, then yes, it's possible you made some money. I'm not, but I'm telling you that over the last year or so, this stock has disappointed its shareholders tremendously. If this continues, then the CEO will undoubtedly get into some trouble. There's no question about it. Anyway, coming back to the options chain, so we see that the stock, I mean, I want to go back there once more and look at the 1 year for the volatility. And the volatility is the high was roughly 541 and the low was 356. So notice that at one point of time, the stock was down from 540, roughly 350, which is nearly 40% down. That's enormous drop within a very short period of time. People still do not know for sure what caused that. So it's not that the company is not making money, it is. But the point I'm trying to make is with respect to the options chain, so let me go back there, that does everybody know what this strike price really means, 200? Let's not go to 200, let's go to something close to the price today. Let's say 400. What does, if you buy this particular option with an exercise price of 400 and expiry, as I said, of November 20, 2026, then what's going to happen to your holding? You buy, let's say, these Microsoft options, and they have expiry of November 15, 2026. My question is, what does this transaction represent, and what is your expectation? This is the most fundamental question. So I fully expect one of you to answer that question for me.
Take into consideration, Professor, take into consideration the current stock price.
Well, I mean, you can take anything into consideration, Edward. You have all the information in front of you. So my question is that if you decide to buy these Microsoft options with strike price of 400 and with an expiry of November 15, 2026, what does that transaction represent, and what is your expectation?
Yeah, if the current stock price remain the same as it is up to that point in November, then my stock price exceed my strike price, then I'll exercise the option.
You do not have to exercise it if you hold it until November 15, because the broker will ask you, of course, whether you actually want to buy the shares of Microsoft at 400. If you say no, then he will give you the difference between the price at that point of time and $400. If the price happens to be more than $400 at that time. So basically what I was asking is that if you buy these options, then you have the right to buy Microsoft shares at $400 anytime and up to November 15, 2026, which means that you are hoping that Microsoft stock price will go up. Because no matter how much the stock price goes up, you can always buy it at 400 because of those options. But To your point, Edward, if the stock price, by the way, you asked me what the stock price was, and it is actually $407. Okay, it dropped another $5 today for who knows for why. Anyway, so I mean, I do own some Microsoft shares, but obviously I do not follow in day to day. But the question is that at 407, the stock price, if the stock price remains at 407 in November, are you going to make any money?
Yes, we're gonna make
Yes, you're gonna make.
the differences, the spread between 407 and 400 minus to the premium.
That is correct, dear.
option.
But also remember, you are paying $44.15 for that particular option. So the intrinsic value means what is the stock price and what is the exercise price. What is the difference between the two? That means that if you were to exercise the option right now, you will make $7.17. But you are paying $44.15 for that particular stock option. Same option. That means that something that will give you a profit of $7 only is costing you 44 and 15. What that means is that if the stock price ends up being anything below 400 plus the 44.15, 444.15, you are bound to lose money in real terms. In net, you are going
Yes.
to lose money. So the question to the class is twofold. I hope everybody understands what intrinsic value means. If you do not, then obviously it will be in my slides. Why is the market value of the stock, of the option, so much higher than its intrinsic value? Oh, why? Meaning that market value is the 44.15 of the option. People often get confused between the market value of the stock and the option. I am not talking about the stock. I'm talking about the market value of the option. Market about $44. The intrinsic value, which is the difference between the market price of the stock minus the exercise price, S minus X. Why is that so much higher? Why is the market value of the option so much higher than the intrinsic value? What's the market's expectation? Edward, why would you pay? I'm not saying you said you are going to buy it, but assuming that you would not mind buying that, why would you pay $44 for something that's worth only $7 right now?
Yeah. As you rightly said, sir, you are concerned in the theory of option. For the first instance, you are concerned about the intrinsic value and not the profit. Like when you are talking about the payment of the option, that is the 44.15, that now determines in terms of your profitability on the transaction itself. So in this instance now, you are going to make a loss of the 44 or the option price minus the difference between the stock price and the option value.
Right. I mean, I understand that, but you understand that people are actually buying that option at 44 when they know that it's as of right now, it's only what, 7. Why?
I
These
think
are actual
Yeah, because
prices.
the options are valued, say for example now, in terms of the options, they are sold in 100 bits.
Okay. Let me see if anybody else has think about this.
I
Your
think
answer
it's
is on principle correct, but I think you need to articulate it a little better. So please, somebody else.
I think it's because the option still has the time value and the possibility of becoming more profitable before the expiration date.
And where does that possibility come from, Christine?
Sorry?
You said that the possibility that the what possibility is that? What possibility are you talking about? Why is it that people are willing to pay $44 for something that is worth only $7 today? These are not
Okay,
numbers I made up. These are numbers actually in the market today. Let me show
I
you
think
something
the
else. Let
possibility.
me hold on for a second. Let me go back to something which is even more glaring, and you will see. Okay, as you can see, I am back to the options page. And you can see that the light blue is options whose exercise price is below the current stock price. That's why if you go to the top of the chart, they will tell you that the light blue is in the money right here. That means that the one that has the white background are out of the money. Now, out of the money is a term in the options market. It's a technical term, jargon.
Mhm.
What does that mean? Let's focus on this $450 option. Exercise price $450. What does that mean? It means that if you want to exercise that option today, you are going to have to pay $450 to buy one share of Microsoft. Would anybody do that?
No.
Anybody in this class pay $450 to buy Microsoft when the market price of Microsoft is 407? Would you?
No,
No.
Okay.
you can't.
Then why are people paying $22 for that option?
Maybe they short the position.
One person. Go ahead. Maybe.
Maybe they short the position instead of
No,
buying.
there is no shorting here.
Okay.
I mean, it could be a strategy. That's not what I mean. I mean that people are paying $22.85 for an option that is deep out of the money. That means the difference between the strike price and the exercise price is as much as $43 right now. That means that the Microsoft stock has to go up by at least $43 before this option becomes good at all. Why are people $2.85? They're not stupid. These are actual quotes. This column right here is the last price. If you go to the top, you will see it says last price. That means that's the price at which the market closed. 450. And it also tells you the volume option interest. That means what is the how much is the open interest, meaning the number of contracts on that option? 450. Why?
Well, people like to buy these out of the money options that are a long way from the strike price for hedging purposes.
And how is
And you
that?
also have the theta decay too. to consider.
Well, I mean, are you saying that hedge what? What are you hedging?
There,
Because Chris, I want to understand what you're saying. So my question here is that you agree that people are paying $22.85 to buy these options. Period. There is no question about that. And the option gives you the right to buy the underlying stock, which is Microsoft, at 450 anytime before the option expires, before November 15. But the current price is 407, $43 below the option exercise price. Now, I don't know what you mean by hedging. I would like to understand. You may be right, but you need to explain what you mean.
Professor, so are you asking us like why they buy that option?
Yeah, people are buying that option. You can see
Okay.
here is the price.
So I think maybe they are hedging because of currently they have a like a short position in their portfolio, so they expected the price gonna go down, but they gonna buy that
Hold on, hold on.
option.
Price of what is going to
Okay.
go down?
The market price of Microsoft gonna go down, but they
Okay,
want to
if the
hedge
hold
the
on,
downside.
hold on. If the market price of Microsoft
Yeah.
goes down to, let's
Yes.
say, 390,
Mm-hmm.
how is this option going to help you?
Yeah.
Let me first ask you, what will happen to the price of this option if the price of Microsoft goes down? I hope it doesn't, goes down to 390, but given the volatility, I think that's quite possible, goes down to 390 2 months later. What will happen to the value of this option?
I'm sorry, they expect I tell like the opposite side. They expect the price gonna go down, but they afraid of it's gonna go up, so they buy that option to hedge the
I
position.
still do not understand why you are saying they are afraid the price will go up. If I own Microsoft shares,
Mm-hmm.
why would I be afraid that the price of Microsoft will go up? Maybe I'm not understanding what you are saying. That's possible. But my question actually is very
Professor,
simple.
can I give a try?
Give a what? Yeah,
Give a
of
try.
course.
People buy it because they expect that the stock price will go up, but they're not quite sure. So that's why they just buy the option instead of buying the stock from Microsoft. Because from mid-year, Microsoft will focus on develop the AI, and they have some
It's okay.
news
You don't
of
have to explain why. I fully understand. So what you are saying is that the
Yeah.
people that are buying this particular call option are hopeful that Microsoft stock price will go up.
Yes, at the end of
That
the year.
theoretically, that is the correct answer. That if you are buying a call option on any stock for that matter, then your expectation is that that stock price will go up. But also keep in mind, Fong, that you are actually paying $22.85. So roughly $472. If you later on buy at 450, then your total cost is 450 plus 22.85 that you have already paid, $472.85, your total cost. If you happen to buy Microsoft shares with this particular call option at any point of time before November 15, then your total cost is the price 450 plus the option price that you paid, $22.85, $472.85. Okay, that means you are saying that I expect that at some point of time, how you expect that, I'm not going to ask you. I expect that at some point of time in the next 6 months, Microsoft stock will go up. I hope it does beyond 472. Only then you will make any money. Now let's look at the price today. Price today is 407. The difference between 407 and 472 is $65. So you are saying that in the next 6 months, Microsoft stock will go up by at least 15%.
Professor, but I still don't understand why we have to buy that option when we can buy Microsoft share as the market right now with $407.
I cannot answer that question.
Yeah,
I'm
Professor.
not asking that question at all. I am saying some people are.
Okay.
That's all I'm saying.
Okay.
Yeah.
That's all I'm saying. I'm not saying I will buy it. My point is not that. If you say that it doesn't make any sense, I'm not going to dispute that. The point is that I'm looking at this thing and I see that people are buying it.
I think, Professor, the answer maybe is that they're buying that because the option is you buy the right, not the obligation, and there is a chance the volatility will play out. So eventually,
That's
the price.
exactly the answer I'm looking for, Peter. That's
Yeah, so
exactly right.
eventually you can make a profit, especially if the volatility is
Of
high,
course.
because it's also
Of
it's in the
course.
it's in a that determines also price of the options.
You realize that when you are looking at actual market prices, which is what these are, there are two sides to this thing. One is people that are buying, but there are also people that are buying these call options. Now, always keep in mind that options are not created by the company. Options are created. This is a very important point to keep in mind. Options are created by the board of options exchange. And what they do is that they will introduce to the market, let's say for a particular expiry month and date, options with different strike prices. That's what they do. Now they introduce it to the market that these are the options that we are actually opening right now. Then the trading will start. Some people will buy the option, but in order for you to buy the option, you have to have somebody who will sell it, because the company doesn't sell. JP Morgan doesn't sell options. Some other customer or client has to sell it. So when the market opens, for every seller or buyer, there has to be one seller. Now think of it this way, that there are some people who are buying and some people that are selling. And the consensus price is $22.85. Now, if I am actually, let's say I am thinking, no, this doesn't sound too right to me. If somebody wants to buy this option from me at 22.85, I'll gladly sell it. And why? Now, remember, if I sell it, I'm going to get $22.85 right away. And I know that I don't have to do anything until November 15 if the stock price does not go beyond 450. Because if it doesn't go beyond 450, people are not even going to come. They're not going to buy the stock from me. So that's what sellers are looking for. That, this looks like a great opportunity for me to make $22.52 or 85 cents. Now, look at 400. Look at this one, 470. $470 stock price, Microsoft stock price. Even that is selling for $17.38. So I may actually decide that if you want to pay me $17.38 to buy this option, I'll sell it to you. And if the stock price doesn't go beyond 470, which at least if you ask me, I hope it does, but it seems very unlikely. That means that 407 to 470, $63, which right now is more than 15% gain in the stock price. Now, I'm not saying that is unlikely, but rather that's not definitely not going to happen, but seems very unlikely. But I will, if it doesn't go beyond 470, and if I have sold this call option, I'm going to just keep the $17.38. That is called a short call. Buying is a long call, selling is a short call. Now, two people did point that the volatility is the reason. Let me ask the class, do you think it is an attractive strategy to sell this call option at $17.38? What do you think, Tram?
Could you please repeat the question? Thank
Okay.
you.
Let me see. Hold on. I will ask the class if anybody else followed. Then I will repeat the question. Did anybody else follow what I am asking? My question is that, is anyone in the class, does anybody see an opportunity by selling this call option at an exercise price of 470 with an expiry of November 15 and get $17.38. Would anybody want to do that in the class? I'm not talking about buying. I'm talking about selling the call option. And if you say yes, then you'll have to explain why. Let me try to reach out to some people.
Maybe can be if
No,
it's, we
hold
don't
on
expect.
for a second, Peter. Julia, are you following?
I'm not really sure.
Okay. Okay. How about you, Cliff? My question to you.
It's not
my
a risk
question
I'm
to
going
you,
to take
Cliff.
because while I may get the premium for selling at $17,
Yeah.
there's an unlimited upside. So it's not something I'd be interested in doing.
No, I'm asking should or not. I'm saying, given the current price of Microsoft, would you do it? Yes or no? Would you
No.
sell? You would not sell.
No.
Okay. Does anybody want to sell this option? Peter, you are saying something. I stopped you. Go ahead.
I mean, if I determine the Microsoft stock price won't reach 407, and meaning my position, what I wrote and sold, that won't be executed, then I would actually sell this.
I'm asking you that if I ask you this question in the exam and say that only yes or no answers are acceptable, what would you say? Like Cliff is saying, no. What would you say?
I mean, probably not. But again, I should analyze the stock. So after I analyze,
okay, that's a fair answer. That's a fair answer to say that I am not prepared to answer that question. Okay, I accept that. My point is that given the information that everybody else has, because everybody else has actually the same information as you saw in the Yahoo page, is there anybody who is interested in selling that option? I am not talking about selling the call. People often get confused between the stock and the call. I'm talking about selling the call option, that if you sell the call option today, you are going to get $17.50 with the understanding that this option will be exercisable if the Microsoft stock goes beyond 470 before November 15. Now, 2 or 3 of you have answered that I don't know. I don't know the volatility or something. So I don't know. I need to make more analysis. Very fair answer. My question is that, is there anybody who might actually want to do that? Now, you understand that some people are.
Yes, I will. I will.
There can be no trading. Yes, sorry. Go
Yeah,
ahead.
I mean, yeah, I will shop the call option with the current
short the call option. Who's saying that?
Phone. Yes.
Okay. So Fyong, you said you will short the call.
Yes.
So you are expecting that, given what you know, that the likelihood that the Microsoft stock price will go beyond 470 in the next 6 months is very small.
Yeah, I mean the same with the first, when you asked the first questions about buying it. So I think that for this one I will sell with the current situation.
Look, notice, buying and selling are slightly different. Here is why. Because if you buy it, it's going to cost you $17.50.
Yes.
And if the stock price does not go beyond 470, you have lost your investment. You have lost your $17.50 because the stock price never went beyond 470. And as you know, as all of you know, that the minimum number of options that you have to buy is 100. So you are talking about an investment of 1750 that you will lose if Microsoft does not go beyond 470. On the other hand, if you sell, then if the Microsoft stock does not go beyond 470, you are just going to keep your 1750. So buying and selling are slightly different here.
I think I agree with Phượng because I will sell it.
You will sell it.
Yes.
Okay. Okay. The point I'm trying to make And several of you have already hinted at that. Let me go back that page again. And
Professor, just one note. Isn't
yeah,
it a covered call strategy when you already have the
no,
stock
I'm not
position?
talking about covered call. I will come to that in a second.
Okay.
What we are talking about is naked call, meaning that you don't own the stock, you're looking for trading in options, and you see that there is an opportunity here for me that if I sell the 470 exercise price call option, I don't expect the stock price to go beyond that. I will coolly make $17.38. Now, notice that there is some information given here, which is at the very last column, which is the implied volatility. Now, those of you that are not familiar with Black-Scholes option pricing model or implied volatility, we will hopefully get to that before the end of the class today or tomorrow. Implied volatility is one of the most important characteristics, or volatility is one of the most important characteristics of options. And notice that all of these options have implied volatility of around 33-34%. Now, of course, the market has been acting very, very erratic since the Iran war started. But historically, what is the volatility of the S&P 500 index? These are fundamental questions for which you don't have to give absolutely correct answers. You have to give answers that are approximately true. And this is a very fair question, given that you are a finance major, you're graduating from one of the risk management programs in the country, and people ask, hey, what is volatility, annualized volatility of S&P 500 index historically? What is that number? Roughly around 18 to 22%, you might say 20%. Notice that Microsoft's volatility, annual volatility, is at least 50% more. That's huge. For a stock like Microsoft, which is a big chunk of the S&P 500 index, to have volatility, which is 50% more than the market, is a matter of concern. Now, all of you must know, let me see if the class remembers. I expect that either Fan Yang or Yakov may have actually talked about that in statistics-oriented lectures. What is the 95% confidence limit of a distribution with mean of mu and standard deviation of sigma? Do you remember 95% confidence limit?
2.365.
Huh?
2.365.
Mu plus minus 2 sigma is what I'm talking about. That the
Okay,
highest limit, 95% highest limit is possibly mu plus 2 sigma. 95% lowest limit is possibly mu minus 2 sigma. Now, for argument's sake, let us say that Microsoft's expected return is 10% annualized. So mu is 10 and sigma, they are saying, is 32.68. Let's say 33. That means that Microsoft with 95% confidence can go up by mu, which is 10, plus 2 sigma, which is what, 65, which is 75% up in the next year, 75%. Or may go down mu minus 2 sigma, which is 10 minus 65, minus 55%. That means that over the next year, with 95% confidence, you can expect Microsoft stock to drop by 55% or go up by 75%. 470 to 407 to 470 is roughly 15% gain. That's it. That's what explaining this thing. right here. That if there is a possibility that yes, with 95% confidence, the stock price may go up 75% or go down 55% in the next 1 year, not 6 months. We will have to work out the standard deviation over the next 6 months. We'll have to take mu divided by 2, which will be 5%. And then we will have to adjust the standard deviation to go from 1 year to 6 months. But I can work out a number with 95% confidence limit and see that, it doesn't really look that unlikely. See, that's why I started by showing you that from in the last 1 year, 1 year and a few months, Microsoft stock has gone from 545 to as low as 350. That's why these options are so expensive. That means the lesson is value of options derives from 2 sources. 1, what is the stock price? But number 2, what is the volatility? And the volatility is not historical volatility. Microsoft's historical volatility will not be 32%. It will be less. But right now, market has no confidence in Microsoft. That's why these options are so expensive. That's why these options are so interesting also. That means that if you really want to take a chance, you might as well think about this. I'm not saying that you should, but I'm saying there is a possibility. Let's go to the 500 right here. $500 means that the stock price must go up nearly $100. So 400 to 500, I'm just approximating, $100 on 400, 25% gain for these options to be anywhere near exercisable. Even that is selling for $11. That's entirely because of the volatility. The more volatile the stock, the bigger will be the value of the option. I will show you after the break as to why that is the case. That when you are talking about options, now there are several other factors. We'll talk about that after we come back from the break. There are several other factors that determine or influence option prices. But the number one factor that you must never forget, that the value is coming from the volatility of the underlying stock, period. That the more volatile, the more risky, that's the paradox about options, that the more risky stock, the lower will be its value, but the option value will be higher. Because market, when they are actually, see, because the option itself does not have any value at all. It is deriving the value from the underlying asset, the stock. So this is a risk play, purely risk play. Now, I'm not talking about hedging and all that, which is a different issue altogether. And some people mentioned that there may be people that are hedging with these positions. Of course, there are. For example, after the class, we will see as to how you can actually use this thing for risk management. But I'm talking about people that are trading. Because one of the things that you must keep in mind that hedgers cannot trade if there are no speculators. If everybody is wanting to trade mainly for risk management, there will be no trade. There has to be speculators in the market. What I was talking about is speculation. And one of the things that we will look into after break is how you can actually, and I think some of you may have already hinted at that how you may be able or willing or interested in actually selling this call option to hedge your position in Microsoft. Yes. Any questions so far? So we have covered some ground, but there is still a lot of ground to be covered. I hope to go through put options, and I hope to go through some of the strategies. As I told you, I won't keep you for too long because you need to review this material before next class, and also try to read the convertibles case because that will consume some of the time tomorrow, a lot of the time. But any questions so far? So a call option, remember, is the right to buy before we long call. And one of the things I'll always keep in mind that there is a long position, there is a short position. That for somebody to go long, somebody must sell, somebody must be short. So how do you go from a long position in call to a short position? So a long call is right to buy. When you talk about a short call, just flip the right to an obligation and flip the buy to sell. So if a long call is a right to buy, a short call is an obligation to sell. Similarly, a long put is a right to sell. All of these are in my slides, which I will show you before the end of the class. I don't see much point in reading back from my slides, but they are all very, very comprehensive, and I'll show you. A put is a right, long put is a right to sell. That means a short put, flip the right to an obligation, is an obligation, flip the sell to a buy. So a long put is an obligation to buy the underlying stock. Very, very interesting market on options, but very risky also. But that's the whole point, that this whole market is operating on risk assessment. That's it. That if there is one word, one characteristic that is driving this market, it's volatility. Which means that these people are not actually interested in avoiding the risk. They are playing it. And they are playing it in a way so that they can make money. So obviously, you need to have tremendous training and tremendous amount of stamina to stay in this market. Particularly now. That now is the best time for options, but now is the most risky time also. Okay, folks, it's about 7:45 by my watch. We will take a break at this point of time. We will come back. I have about 15 students, not 15, including myself, about 15, so 14 students. I hope all of you will come back around 8 o'clock. In the meantime, I will put the recorder on pause. Please remind me to start it when we come back. All right, folks, I'm back. Can you all hear me?
Yes.
Hello?
Yes, we
Okay,
can hear
very
you.
good. So, as I said, I usually do not talk a lot of material on the very first day, but I will definitely finish the discussion of the option fundamentals. So, what we were talking about is why are prices of out of the money options apparently so high? That means that why would anybody pay as much as $11? Once again, I'll read all of you to be on video because it makes interaction that much more effective and interesting. So please, if there are no problems, then try to be on video. So the thing is that why are out of the money, sometimes deep out of the money options so expensive? And the answer seems to be that it's the volatility. That higher the volatility, the higher will be the price of the option. Now, before I get to why are people still buying or selling for that matter, because they are, I mean, there is no question that they are. These expensive options, quote unquote expensive, because the expensive is really not a correct word in the market, because the market is the most fair. The United States market is the most fair and efficient market in the world. So it's not correct to say expensive. We should just simply say it seems like yeah, out of the money options are selling at quite a high price. But before we get to the, some people have mentioned hedging and all that. We will get to that. But before we did that, let us actually take a look at quotations for put options to make sure that, yes, we understand the most basic fundamentals of options. So let me show that. And these are the same, it should be the November 20, 2026 options. And these are all calls, of course. And below that, you will see you will see the put options. Notice that the call, the strike price ranges from 200 to 700. Now you can imagine, as I told you, that these options are introduced by the Chicago Board of Options Exchange. It's not clear as to why Chicago Board of Options Exchange would actually issue a call option with an exercise price of 200. Doesn't make any sense. Sure, because it's unlikely that Microsoft will go down to $200. So, and of course, that's the price is also equally high, 228, because as you can tell, that this option, the $200 exercise price option, is in the money by 407 minus 200, $207. Then there is a premium, and the price is 228. But the thing is that notice that the strike price goes up to $700, and even up to 650. I don't know why the 655 option is higher than 269. That is simply a matter of when this particular option traded for the last. So don't pay too much attention to that. So the question is that when you're talking about 650 option is $250 more than the current stock price. If 650 looks absurd, let's go to 600. Even 600 is 50% more than the current stock price. If you were asked anybody sane as to what is the likelihood that the Microsoft stock will go to $600 before November 15, I don't think anyone will say, well, it's possible. I mean, technically, yes. So you can tell that, yeah, some people are still willing to pay $2.72. Now, to many people, that $2.72 would simply look like free money. They're sitting there, just take it. What do I mean by just take it? Meaning that call your broker and say, I want to sell 2 contracts, let's say. 2 contracts of Microsoft November 15, $600 exercise price call options. I hope that everybody, or I suppose everybody, understands that 1 contract of option is underlying 100 shares. That means that you are actually selling options on 200 shares of Microsoft. So 200 times this is $2.72. Is roughly about what? $550. So Peter, does the $550 look free money to you? I'm talking about this particular option here. Does that look like free money? Just sitting there? So you can call your broker tomorrow
I mean,
I will tell you that
so
broker is not going to
so the price is two something. That's the price of-
$2.72.
Yeah, no, I wouldn't take that risk.
You
For that money.
you have to explain what risk are you talking about?
I mean, if I sell that option and then that Microsoft price goes up, they can be executed. Then I have to purchase that. I mean, they have the right to. I have to sell them the stock for that price.
That's $600.
Yes.
And you think that is risky? That's a good
I
point.
mean, I don't know. I mean, but I mean, again,
But-
it's hard
but
to
let me
tell
elaborate
without
on that.
calculating. But
No,
it's
Peter, I think
definitely
you made a good
better.
point.
But there's definitely less chance than if the strike price
Okay.
would be low.
But I see what you are saying, because let me explain to the class what he's trying to say. That assuming that he does not own Microsoft shares. Now there will be a problem if he does not own Microsoft shares, because if he calls his broker tomorrow and says, "Hey, our professor told me this. Let me sell 2 contracts of options on Microsoft at exercise price of 600, and give me $550." His broker will say, "Get out of here. I'm not going to do it." Why? It is because what he also said, that if you ask anyone, is there a chance that Microsoft will go beyond 600? The answer is that probability is not 0. We can calculate that probability as a matter of fact, given the exercise, given the expected return, and you already know the volatility, which is about 33%. We can calculate that. And of course, that probability will be very low, but as he correctly pointed out, it will not be 0. That means that there is a finite probability greater than 0 that yes, Microsoft may go beyond 600, which is 50% above the current stock price. It may, sure, non-zero probability. And the broker, that's why he will say, the first question he will ask Peter, do you own the shares? Peter, if he doesn't, will say no. Then let me ask the class, why will the broker not allow him to sell the 2 option contracts at exercise price of 600? Why? Let me repeat the question. Peter does not own any Microsoft shares. Let's say I gave you this question in the exam. Peter does not own 200 shares of Microsoft, but he calls his broker and says, I want to sell 2 option contracts with November 15 expiry and $600 exercise price. And the broker says no. Why?
Because the broker is ultimately responsible for completing the trade.
Of course. Thank you, Cliff. Because the broker has the risk now that the person who bought the 2 option contracts from the broker will demand, hey, stock price has gone beyond 600, give me the 200 shares. And if Peter does not have them, then Peter has to buy those shares at 600. That means he will have to come up with $12,000. Broker is not going to take the chance if he doesn't have that. That means that he has to post some collateral, which will either be Microsoft shares, or maybe, okay, you don't have 12,000, give me 6, 7, 8, whatever. Because as Peter correctly pointed out, the likelihood that a Microsoft stock will go beyond 600 is very small, but it's not 0. It's not 0. That's part A of the question. Now, let me ask you part B of the question. And the part B of the question is that the broker knows that Peter has an account with the broker where he has 500 shares of Microsoft. Would the broker then write the 2 option contracts?
I think it would, because there is a, I mean, then I actually bearing the risk holding that stock position was the volatility on the underlying.
Okay, okay. Now you keep saying risk. What is your risk, Peter?
I mean,
Let me repeat the question. I have changed to part B, where I'm saying you actually have an account with the broker with 500 shares in the account. And the broker says, okay, Mr. Peter, if you want to sell 2 option contracts with November 15 expiry and $600 exercise price, I have done that. Here is your $570, 272 minus times 2, 500 and whatever, 540, 40, 45, whatever it is. And you said, I have risk. What risk do you have?
so so first of all, I have a gain right away from the premium, the $2 something I
Of
collect.
course,
When
you have $550, yes.
Yeah. So, but holding that position, the Microsoft position, as we talked about volatility, it can go up and it can go on. So go down.
Okay, let's
So-
say, let me now help you a little bit more. Let's say the stock price goes to 610. I'm telling you, if the stock price goes to 610, if any of the students call me at that day on November 15, that you said that if it goes to 610, you will take me to lunch, I will do that. But let's say that the stock price goes to 610 on the day of the expiry. What is your risk?
Can I answer that?
Go ahead.
Okay. Let's say if I owned 500
You own
Microsoft
500
stock
shares of Microsoft,
today,
yes.
yeah, which I bought at a price for
No.
407.
I don't know that. I never said that. I never said at what price you bought. I
Okay.
said, you know that the price today is 407. Don't go to at what price you bought. It doesn't matter.
Okay. So let's say if I already have a Microsoft stock, and if it's gone down over 600, and my the other side they execute the option, I will have option to sell them. Yeah.
But
So
Peter
they will
said
definitely
he
benefit.
sees some risk. Do you see some risk?
I don't see
No,
risk.
I don't think there is a risk because the stock price has gone up, so he has even make a gain. So the broker can easily settle the account, without incurring any risk.
You see, Edward, you answered the question.
Yeah.
So you now, in turn, should ask me the following question. That, hey, why are you so stupid? You own Microsoft shares. Why don't you write 2 contracts on Microsoft, 2 option contracts on Microsoft at exercise price of 600 and November 15? I tell you, I should. Here is why. Because my risk is that I will have to, which is what I think she was trying to say, my risk is that I will have to give up my shares at 600. I will do that in a moment. You understand what I'm saying?
Yes, I agree.
So I will give up the Microsoft shares at 600 in a moment. And here is the other catch. That notice that until and unless it goes to 600, I keep my 550. Nobody is going to take it away from me. Nobody. I don't do that. I am thinking that I may actually start doing that. However, a lot of people do. And when you are selling a call option on a stock for which you own shares, that means your position now goes from short call to long stock plus short call. A lot of people do that. Why? Because it immediately gives you a profit, and it does expose you to some risk, but the price that you choose is already above the current stock price. So you don't lose money actually. And also remember, if some people say, well, the stock price was 610, you said I have to give it up at 600, and the stock was really going to do well. I said, okay, go ahead and buy again. Nothing is stopping you. If you think that the momentum for Microsoft will continue, just go ahead and buy again. So a lot of people who own shares do actually do covered call. But you have to be prepared that when you are doing a covered call, remember, we talked about naked call before the break. Now we are talking about covered call. Covered call means that your call position is covered by long position on the stock. So when you are doing a covered call, you already know that I am willing to give up my Microsoft shares at 600. I mean, if you think that no, 600 is too far, there's no possibility, very little possibility. Okay, I want to make a little more. Fine. Let's go to 550. 550. You will be making 532 on each contract and nearly $1,000 on each. If you think I'm willing to give up my Microsoft shares at 500, okay, let's go to 500. At 500, you will be making 1,100 times 2, $2,200. But as some of you pointed out, you need to realize that I'm willing to give up my Microsoft shares at 500. So will a lot of people do this? Of course. But once again, as I said, you cannot sell until somebody wants to buy. So some people in the market, now, of course, one of the things that has been pointed out by Cliff and several others, that there could be people who are buying for hedging purposes. I don't really care about it as to why they are buying. All I'm saying, for you to be able to sell, there has to be a buyer. So we talked about long call, short call, and covered call. Always remember, covered call, you make the money. And you are actually happy that I may have to give up my shares at the exercise price.
Professor,
Means
just one
that-
comment. Sorry.
Was there a question? I'm
Sorry
sorry.
for a
Right.
cover call, but you have to be a little bit bullish on that stock position, because if you think that the stock that the
Not
company
necessarily,
is,
Peter. Let me tell you another thing. Let's say that your stock price is right now 407. Now, by definition, if you own the stock, then you only have downside risk because you have upside potential. So your only concern, my only concern is how much more money am I going to lose on Microsoft? I mean, this stock has bled hundreds and thousands of people over the last year. Nadella better do something to stop this bleeding. Otherwise, I can tell you that he will be out in a year. There is absolutely no justification for the stock to be losing as much as 30% as we saw in the last year or so. This is intolerable. But people are still sticking with it because of how the stock has behaved over the last 30 years. So now, let's say, given the volatility, listen to the question very carefully, Peter, because it goes to the point you are making. Given the volatility, I am not even sure that the bleeding has stopped. Particularly if the uncertainty, you know that the president is in China, and then Iran is basically, I think, maybe I do not understand politics that well, but from all indications, it seems like Iran has gotten the United States by the horn. That when you get a bull by the horn, then the horn has really nothing else to do. And I think that they possibly miscalculated the criticality of Hormuz. We don't want to get into politics too much, but this is not politics. This is basically international economy. No one, not just this president, no one, I think, in the world understood how critical the Hormuz Strait is. So I'm not blaming anybody. All I'm saying is that until that is settled, Iran has got the upper hand at this point. So the problem that we have in the world now, that there is no easy way out. And people may be saying whatever they want about the president. I am not saying I support him or I do not. The point is that it is not easy, because for a man in that position, everybody has ego. I have ego, you have ego. So got to keep that in mind, that the man has a lot of ego. It's very difficult for him to pull out. Anyway, so let's say that this uncertainty continues. And I think there is a possibility that the stock price, not just this one, but the entire market, may go down. Let's say I am afraid that stock price may actually go down to 390. My question to the class is that if that is given that expectation, if you are my financial consultant, given that expectation, would you recommend that I sell this 450 call option, November 15 expiry at $22.85, 2 contracts? My expectation is that the stock price may drop. Should I sell these call options? Say yes or no answer.
Yes, as long as we have someone willing to buy it.
Oh, that is given. Don't get into that. That is given. That's not my problem. That's the broker's problem. My question to you is that you are saying that, yes, I should call my broker tomorrow and sell this $450 option if I believe that the Microsoft still has some downside.
Yes.
Yes or no?
Yes.
Actually, that's the point. That I can use short call to protect my downside risk. Because if it goes to 390, then I'm losing $17 on every position. But I already made 22.25 on each of them. And there is no likelihood that the stock will be, that the option will be exercised, because the exercise price is well ahead of 390. So a covered call definitely can be one of the points that Cliff had made, and I think Peter had made, and others had made, can be a hedge against downside risk. That's exactly right.
Professor,
Then
just
it can be.
one question, but wouldn't be a better strategy in this situation if we expect the price of the underlying stock drop, then use a protective put strategy?
Sure, of course, sure. But remember that on a protective put, by the way, as Peter is saying, is that I will explain that in more detail, is a long put, meaning that you sell the put option. Sure, I can do that, of course. But remember that on a short call, I start with an income. On a protective put, I start with an investment. Protective put is an insurance. This is an investment or an income. So the difference between a protective put and a short call is that a short call will give you downside protection with an income. A protective put will give you insurance against downside, but there is a premium to be paid. So I'm not saying that it's a question of preference. He's absolutely right. It is a question of preference. But I know that if I did a short call, I am completely secure. If the stock price goes 390, fine, I'll stay with it. What Peter is talking about, that, okay, you have another choice. Let's go to put option. That, okay, if you are, let's say, worried that it will go to 390, here is another choice. Why not sell or buy, rather, a 425, let's say. Now, Peter, let me ask you this question. $425 or whatever price you tell me, I will go there. You tell me at what price you want me to buy. Let's say you are my broker. You say, well, Mr. Ghosh, you have another choice. You can do a protective put, but you have to tell me the exercise price. Tell me.
Sorry, what should I tell?
Well, I mean, if you are my broker and you explained the covered call to me that if your stock price goes to 390 and if you did a covered call at $450, where you can make money on 22.25, that means 2 times 2, roughly about 450 or whatever.
Yeah.
But then you said, why not do a protective put? Absolutely, I can do a protective put, because if I do a protective put at, let's say, $425, then I have the right to sell the stock at 425. When the stock price has gone down to 390, I can do that. But as my broker, you have to advise me what's the exercise price. Or you might ask me that, okay, what's the price at which you want to protect your position? Right now it's 407. So, okay, let's say that I said, well, I don't want my value to go down 410. So we go to 410. I buy the protective put at 410, which means that if my portfolio was worth 407 now, then I can easily sell my shares at $410 when the stock price goes down to 390 before November 15. Is that consistent with what you are saying, that that's another choice?
Somewhat, yes. I mean, I would choose like which is kind of the cheapest one compared to the
you tell me. You tell me.
Yeah, I mean, if I see a risk that's going to 390, probably.
So if it goes to 390, if I have the long puts at 410, I can immediately sell my option at 410. I'm protected. But that's costing me $34. So 340, if I do 2 contracts, 340 times 2, $680 is what that insurance will cost me. So now the question is that if it goes to 390, if you do a short call, you will make about $540. You will stay exposed to the stock. On the other hand, you can do a $410 long put, but that will cost you $680. Both are possible. I am not making a judgment call here. That's the investor's decision. So there are no right or wrong answers here. Both are right answers. But you see that on one of them, I'm starting with an income, but remain exposed to the stock, maybe more downside. On the other one, which is one you recommended, I am fully protected up to 410, but there is a pretty high insurance premium. That's the problem. So it is not, a lot of people get hung up with the strategies and all of that in options. We will discuss all of that tomorrow, but the fundamentals are very important. That when you are talking to your client, the client will not understand anything about the technicalities of options. You have to explain that in very simple terms. That on one of them, you remain exposed, but you start with an income. On the other one, you are fully protected up to 410, but guess what? As with any insurance, there is a premium. And as the investor, or meaning the client, the decision is his. This is not an easy decision. I will tell you. In the student fund, and that's where I learned that when students are forced to make that choice, they understand. That what happened is that in the student fund, if you know any of them, you can talk to them. In the student fund, for the FERM fund, students are allowed to do options. And Jaideep Shanai and I were advisors. And of course, they could do covered call, they could do protective put. So they had these volatile positions on NVIDIA and all that. In some of them, they actually lost money. On Microsoft, they got stopped out. But when we suggested, or not suggested, we told them that you can do protective puts. And when they saw the cost associated with it, they said, no, we are not going to do it. Much easier for us to go with a stop loss. Does everybody understand what a stop loss order is? If you
Yes.
do not understand what a stop loss order is, before tomorrow's class, find out. There is a lot of information source. Find out what is a stop loss order. And the question will be that how would you choose between a stop loss order and a protective put? And I will tell you, the student fund managers chose the stop loss order. Nothing in the finance market or capital market is free. So we have talked about long call, we have talked about short put. And we see, we have talked about long put and short call. So we see that in one of them, you have a cost. Notice how beautifully it can be structured. So in one of them, let's say that we will do a protective put at, so let's say that you are talking to a really wealthy investor. Portfolio managers and wealth managers define wealth starting at about $5 million. That a client has come to you with a retirement portfolio of $5 million and says that, you know what, I have huge exposure on Microsoft, 4,000 shares. I'm a little worried. So you said, well, you can do covered call because these are long positions, or you can do protective put. And then you show him, he loves the put, which is an insurance premium, but he says, well, but it's very costly. Then the broker can flip it around. He will ask that, okay, your stock price right now is 407. What is the minimum value that you are willing to absorb? Let's say that on the client says 400. I don't want my share price to go below 400. Okay, fine. Let me ask the class, what is a guaranteed way to make sure that the value of the portfolio does not go below $400 per share? Easy. Just do a $400 put option. $400 put option is roughly $29.40. Let's round it to $30. So the client says, well, I agree that if my stock price value does not go below 400, I'm happy. Then the broker says, but it is going to cost you roughly $30 per share. That's pretty high. He doesn't like it. What can you tell him? That means that he has to have some way of offsetting that cost. What would be that?
I mean, the stop loss is practically free. It's not guaranteed it will be fully executed at the 400 price if it's set to that. No, what was 390? Because it's triggers at the price.
No,
it's set.
we are not talking about 390 anymore.
Okay, 400.
400.
Yeah, so it triggers at 400, but after it's selling the whole position at market price. So if the price going forward down, then it's not a liquid asset, then can cause a problem. But typically, a liquid asset is not really
for Microsoft, the liquidity is not a question. Remember that $400 put option will be exercised only when Microsoft stock goes below 400. Otherwise, it will not be. So it gives you all of the downside protection below 400. So you tell your client that no matter where the stock price goes, if it goes to 50, it doesn't matter. You will be able to sell your shares at 400. Client says, I'm happy. No problem. But then he says, well, but I'm sending $30 for each. That's pretty high. That's when you tell the client that, okay, here is something you can do. Then you go to call options and you tell him that, how about, that was $30, remember. How about you, let's say, sell call options at 440, or let's say 450. Buy the put at 400, sell the call at 400. So the client do for me. He says that you will be able to sell your stock at 400 if the stock price goes below 400. On the other hand, if the stock price goes above 450, then you are going to have to sacrifice your Microsoft shares at 450. The client says, fine, that I am okay. Then your net cost is 30 minus roughly $23.7. That means the income on the covered call will offset the premium for the protective put. That's what big shareholders do. And it's all a choice of the exercise price, of the protective put and the short call. You can actually choose the exercise price in a manner that your net cost is zero. That's called a collar strategy, COLLAR. Very, very effective for people with very large exposures in single positions. I mean, you can do it even with the SPY. You can do a collar strategy with SPY also. It is all a matter of choosing the exercise prices in a manner where your net cost is nearly zero. But of course, nothing is free. You can play around with the exercise prices, but you can come up with a combination that the client is saying, okay, fine, I understand that. That means your downside is defined, your upside is defined also. It's already 8:40, so let me stop here. As I expected, I did not go too far today. I will show you my slides. These are the slides. And these are the slides where all of the concepts have been discussed. And you will see that there are definitions and everything. So please go through this if time permits. I will show you all of this after we discuss all of that in class. But let me also see how far we have come. So this is the topics we have covered. We have not covered option attributes. We'll start with that tomorrow, meaning what are the different characteristics of options that determine its value. We'll talk about leveraging and then some of the option strategies, and possibly have time to start with convertibles. So some of that we'll go over to next week, but there is a tremendous amount of material here, which I do not want to shortchange. Anybody, I'm sorry, I didn't share this. So, but look at the option topics. Anybody has any questions at this point of time?
Not about the class, but is there any way you could turn the volume of your microphone up in the future?
Oh, that, why, are you having some difficulty hearing me, Cliff?
You're way softer than everybody else's voice.
Really? Oh.
Yeah.
I
put it this way, I'm old enough for my tinnitus is louder than your voice right now.
I will definitely, I may not be able to do it tomorrow, but I will definitely look into it before next class. That's for sure. I'm sorry about that. I didn't have any such feedback when I was teaching last fall, but obviously this is something that must be fixed. I won't have time tomorrow, to be honest with you. So you will have to play the recording as high as possible, but I promise you that I will look into this from next week. Thank you for the feedback.
That's good.
Did anybody else have difficulty hearing me?
Sometimes your volume amplitude though is like fluctuating.
Well,
Sometimes,
that is because I am moving a little bit, Peter. So
Yeah.
I will have to make sure that I possibly have a speaker. That way the speaker moves with me. I think that is the problem. I'm not using a speaker today.
Yep, that's mostly causing me an issue. I mean, if you normally talk, then it's fine for me. But yeah, it's not probably that loud for other professor. But if you move away, then sometimes the volume drops.
Yes, I am sure that is what is happening. It is an easy fix, but as I said, I would have done it tomorrow, but I have meetings throughout the day tomorrow, which is why I will not be able to fix it tomorrow, but I will definitely have it fixed before next class. If you have missed anything, please come back with questions. I'm not going to rush this fundamental material because it is very exciting and it is very informative. And if necessary, we will pick up any slack with extra time later on. Okay? You know where we will start tomorrow, possibly the slides, the put call parity and all of that, but fundamentals are very important. If you understand long stock, long call, short call, long put and short put, all strategies are combinations of this. That's it. There is nothing else. So it is very, very important to understand these basic fundamentals. The most frequently used are long call, long put, and short call. Short put, not much. I will explain to you why short put is not that widely used tomorrow. You will see what devastation it can cause if the stock market suddenly goes erratic. And that can happen. A lot of people got wiped out. I will explain to you when. Short put was actually quite popular at one point of time. Then hundreds of people got wiped out during the short put. And you will see how risky it can be. All right, folks, I will stop the recorder at this point of time. Thank you very much for attending. I hope to see you again at 6 o'clock tomorrow. And there is a lot of more exciting material. I may not be able to finish convertibles, but I hope to start it and finish it next week. See you tomorrow at 6 o'clock. Bye.
Thank you.
Bye.
I'll stop the recording.
Thank you, Professor.
Thank you.
Professor.